In this video, I'm going to go over three kinds of ICT concepts. The first one is high resistance liquidity run. The second one is low resistance liquidity run. And the third one is market structure shift. So first, I'm going to show you what a high resistance liquidity run could look like. So let's say price comes up and touch a form of resistance level, and then we go lower, taking out this low right here, creating a market structure shift, confirming that this high that touched the resistance level is a long-term high. So now that we have got a market structure shift and price has moved even lower, it is going to be hard for price going all the way up to this long-term high because there is a lot of resistance levels above these old highs. Some of the reasons you don't want to be trading in high resistance liquidity runs is because, as I said before, there's a lot of resistance before price is going all the way up to this long-term high. So let's say price chose to go up to this high and then just go lower. So that is why you don't want to be trading in high resistance liquidity runs, because you don't know if price is going to reverse at these old highs we made from the bearish run from the long-term high. For the next example, I'm going to show you what low resistance liquidity run could look like. So let's say price comes up and takes out a old high, as you see right here. And then we get a large expansion to the downside, creating a market structure shift. And in this large expansion, we don't want to see any form of large retracement. So when price starts to move up again from the large expansion, creating a low right here, also creating a higher low, and then a market structure shift to the upside. This range from this low to this high, there's low resistance liquidity. So that means it is easy for price going higher and taking out the highs that we form on the way, because there's going to be buy stops at these highs. But when price goes up to this low that we got from the large expansion to the downside, the market structure shift, there's going to form high resistance liquidity runs. So basically, whenever we move above this market structure shift, it is going to be hard for price going even higher up to this high resistance liquidity range or high we have up here that we formed after we took out this old high. So whenever we have high resistance liquidity run to the upside, when we go above this market structure shift, there's going to be low resistance liquidity runs to the downside. And when we have this low resistance liquidity run to the downside, we want to be targeting the lows that we formed to the upside, because there are going to be sell stops at these lows. Just to clear things up, price comes up and take out this old high. Then we get a large expansion to the downside, creating a market structure, confirming that this high up here is a long-term high. Then price starts to move higher, creating higher lows and higher highs, also making a market structure shift. Then from this low market structure shift to this high market structure shift, there is low resistance. So that means there's low resistance for price taking out highs, because there's going to be buy stops above these highs. When price comes up and touches this low right here, where we created the first market structure shift to the downside, that's going to form high resistance liquidity runs. And when price form high resistance liquidity runs to the upside, there's going to be low resistance liquidity runs to the downside. So when we form this low resistance liquidity run, we want to be targeting these lows because there's going to be sell stops below these lows. For the next example, I'm going to show you what a market structure shift is. So let's say price comes down and touches a form of higher time frame resistance level, and then we start to move higher, closing above a high, creating a market structure shift. So a market structure shift is basically price touching a higher time frame resistance level, and that I think is very important because you have to have the higher time frame on your side, and then price moves higher, closing above a high, and that shows price has shifted the order flow. So now the order flow is bullish. And what I like to see when price forms a market structure shift is a fair value gap in that market structure shift. Right here. So now that we know all of the three concepts, we can go into the charts and find some examples of this. So for the first example, price has come down and touched a 4-hour fair value gap. So we want to see this low right here being a long-term low. Right here we get a market structure shift from this high, confirming that this low right here is a long-term low. Then price comes down and touches this fair value gap, not going all the way down to this long-term low. So that shows us this is a high resistance liquidity run right here. So now that we have the higher time frame on our side and the lower time frame, we could expect every bearish movement to be a high resistance liquidity run. So right here price moves higher, and this is a 1-hour fair value gap. Then price comes down into this 1-hour fair value gap, creating a old low. Also this is an old low. So there's high resistance liquidity run for price coming down and then managing to taking out this old low. Then price moves higher, creating another market structure shift you see right here with a fair value gap. And then moving higher, creating a new high resistance liquidity run to the downside into this fair value gap right here, creating new lows and all the way up to this long-term high. So just to give you a recap of what just happened, price came down and touched a 4-hour fair value gap. So that means we have the higher time frame on our side. Then we create a market structure shift within a fair value gap, as you see right here, confirming this low as a long-term low. Then price comes up and then goes all the way down to this market structure shift, and price also makes a market structure shift at this low right here. So this range right here is there's low resistance. As you see, right when price goes below this market structure shift, there's high resistance. Liquidity runs to the downside. So that means there's low resistance liquidity run to the upside. And when we have low resistance liquidity run to the upside, we want to see price taking out highs with ease. As you see right here, price don't even make a small retracement. So that confirms we have a low resistance liquidity run to the upside. So every down movement is a high resistance liquidity run that we could take advantage of to seek liquidity at the swing highs that we form, because there's going to be low resistance liquidity at these highs. So then price comes down, and this is a high resistance liquidity run. Then we touch a 1 hour fair value gap. Then we have a low resistance liquidity run going even higher. Then we trade a new market structure shift within a fair value gap. See right here. And we go higher, creating a high resistance liquidity run to the downside, touching this fair value gap. And then we go even higher, taking out this high right here. So this is a low resistance liquidity run example to the upside, and a high resistance liquidity run to the downside. And if you go over to the other side, you could see we actually took out a high resistance liquidity, or a long-term high, because we took out this high right here, and then creating a shift in market structure. And if you go into the lower time frame, you could see we also created a shift in market structure right here. We could just move this up right here actually. So let's see right here, this long-term high got taken out by this low resistance liquidity run to the upside, because we have the higher time frame on our side. So we could anticipate price actually going all the way up to this high resistance liquidity high. For the next example, I'm going to show you the second example. I'll show you with the drawings on how you can find high resistance liquidity and low resistance liquidity. So right here we see price taking out this old high, and then we get a market structure shift to the downside, confirming that this is a long-term high. And as you see, we create a fair value gap within this market structure shift, and then price makes a market structure shift to the upside, creating a fair value gap almost within the market structure shift. And then price comes up and touches this market structure shift right here within this fair value gap. So if you were to take a trade entry, you could short at the bottom of the fair value gap, put your stop loss at these long-term highs, because we want to see this not get it traded to, and then target these lows down here. Let's create a free risk reward ratio. And the range from this market structure shift to this market structure shift is there's low resistance. As you could see, it's easy for price taking out the highs that are formed. So just to give you a brief recap of what just happened, price comes up and takes out this old high. Then we get a large expansion to the downside, creating a market structure shift with a fair value gap confirming this market structure shift, also confirming that this high up here is a long-term high. Then price comes down and then starts to move higher, creating a market structure shift. And from this low right here to this high right here, there's low resistance. So that means it's easy for price moving higher, because there's buy stops at these highs we formed. So there's almost no resistance. And then price moves above the market structure shift that we formed to the downside, meaning now the movement to the upside, there's going to form high resistance liquidity runs. And as you see, this 4-value gap right here supports price in going lower because there's low resistant liquidity runs to the downside. And then we go all the way up, down, taking out this low right here. If you like this video, please like and subscribe. And if there's anything I didn't understand, just comment down below.